Owner-operator versus company driver. The real money breakdown. Every driver hits this fork in the road eventually. Stay a company driver with a steady paycheck, or buy your own truck and become an owner-operator chasing bigger numbers. Everybody's got an opinion, half of them from guys who never actually ran the math, and the other half from guys selling you a truck. So let's actually run the numbers. No hype, no sales pitch, just what the money really looks like on both sides. Start with the company driver. You're averaging, say, $75,000 to $85,000 a year gross, depending on your carrier and your routes. Taxes and withholdings come out automatically. You get a W-2 at the end of the year instead of a shoebox of receipts. Health insurance might be on the table through your employer, and your truck payment, maintenance, insurance, and fuel are somebody else's problem. Your paycheck is smaller on paper than an owner-operator's gross revenue, but it's predictable. You know almost exactly what hits your account every 2 weeks, which matters more than people admit when you're trying to build a budget, qualify for a mortgage, or just sleep at night without wondering if a blown engine wipes out your month. Now the owner-operator side. Gross revenue looks huge. Plenty of owner-operators are billing $200,000, $250,000 a year or more, and that number gets thrown around constantly in trucking forums and YouTube comment sections. It's the reason so many company drivers jump ship. But gross isn't income, and this is where most of the confusion happens. Fuel alone can run $50,000 to $70,000 a year depending on your miles and your truck's efficiency. Your truck payment, if you're not paid off, is another $15,000 to $25,000 a year. Insurance runs higher than a company driver ever sees. Maintenance and tires eat a steady stream of cash. Permits and plates add up. And if you're using a factoring company to get paid faster, that's another few percentage points off every load. By the time you're done subtracting, a lot of owner-operators are netting somewhere between $60,000 and $90,000 a year, sometimes less than they made as a company driver, especially in year one, when equipment costs are highest and the learning curve on finding good freight is steepest. Here's the number almost nobody puts on a spreadsheet, and it's the one that actually determines whether owner-operating makes sense for you. Cost per mile. If you don't know your all-in cost per mile, fuel, truck payment, insurance, maintenance reserve, tires, permits, everything rolled together, you cannot actually tell if a load is profitable, or if you're paying out of pocket to drive it and just don't know it yet. Most new owner-operators find out, usually the hard way around month 4 or 5, that their real cost per mile is 15 to 25 cents higher than they originally assumed. That gap turns a rate that looked great on the load board into a quiet loss once you do the math honestly instead of going off gut feeling. There's also a timing problem that trips people up. Company drivers get paid on a schedule no matter what. Owner-operators deal with brokers who pay in 15, 30, sometimes 45 days, unless you're factoring, which costs money too. That gap between running the load and actually seeing the cash is where a lot of otherwise profitable owner-operators run into trouble, not because the business isn't working, but because the cash isn't there yet when the truck payment is due. Quick disclaimer before we go further, because this matters. This is general financial education based on industry averages, not personalized financial or tax advice for your specific situation. Your numbers, your lane, your equipment age, and your state all change the math. Talk to a professional who can look at your actual books before making a six-figure decision based on the YouTube video. So here's what actually works if you're considering the jump or you already made it and want to tighten things up. Rule 1. Don't go owner-operator until you have 3 to 6 months of both business and personal expenses saved, kept completely separate from your operating cash. Trucks break down the month you can least afford it, every single time, guaranteed. Rule 2. Calculate your real all-in cost per mile before you take a single load, and build in a monthly maintenance reserve of at least 15 cents a mile starting day 1, even in year 1 when nothing's broken yet, because something will break in year 2 and you'll be glad you saved for it instead of financing the repair. Rule 3. Keep your business and personal finances in completely separate bank accounts from the very first load. Mixing them is the single fastest way owner-operators lose track of whether they're actually profitable until tax season delivers a very unpleasant surprise. Here's the truth. Neither path is automatically the better one, no matter what the loudest voice in the truck stop parking lot tells you. A disciplined company driver who saves consistently every single paycheck can outbuild the net worth of an owner-operator who's white-knuckling cash flow every month, chasing a bigger gross number.
That bigger number feels better when you say it out loud, but it means absolutely nothing if it isn't converting into money that actually stays in your account after every bill gets paid. The right move depends on your risk tolerance, the size of your savings cushion, and whether you genuinely enjoy running the business side of trucking, the paperwork, the negotiating, the planning, not just the driving. If you want the next video, we're going through every tax deduction truckers forget to claim, and it adds up to more money than most people think. Subscribe, because we're doing this every week.